So people often ask me, what's a hedge fund? And people that don't know it might often think, I'd rather stick with my long-only manager. It's something I know, it's something I'm comfortable with. But in fact, hedge funds in many ways are very similar to the long-only category that most investors are used to. They're also multi-asset portfolios, like a balanced fund or a stable fund. They have a mix of equities, bonds, maybe some offshore equities in there. So very similar to what investors are used to. Additionally, they're regulated under the same collective investment scheme acts. So you've got the same regulatory protections in a hedge fund that you would have in a normal unit trust. They're often typically daily dealing, again, being similar to typical unit trust investors are used to. And finally, on the similarities, they also come in various risk profiles. We've got two main flagship funds, our pure hedge and high growth fund, and they're very similar to the stable and balanced fund categories in the collective investment scheme space, which are two of the biggest categories in that market. So again, it's very similar to investments that investors typically have in their portfolio already. There are then a few key differentiators and things that make hedge funds different from long-onlys. The main one of these is the fact that we can invest in both directions. We can own companies we like, but we can also bet against companies that we think will underperform. And this is such a powerful tool. Normal long-onlys are limited. If they don't like a business or they think it'll underperform, the best they can do is not own it. We can actively bet against that company, make money where it underperforms, and also use that underperformance to hedge the rest of our portfolio. Additionally, hedge funds have additional tools available to protect funds in down markets. It's much easier to use put options, shorting as I discussed earlier, and this means that in choppy up and down markets, hedge funds have a much greater ability to deliver a smooth return profile for investors and protect, especially in the big down months like we saw around COVID and other crisis periods in markets. So what does all this mean? It means that hedge funds are broadly similar to existing investments that you're used to, except that it brings a different kind of return and risk stream to a portfolio. And adding hedge funds to your overall portfolio has the ability to both increase returns, but more importantly, reduce volatility and risk in your overall portfolio through this diversification it brings by using a different tool set.